Hey guys, so in this last video I talked about a loanable funds market where savers and investors meet together in perfect peace and harmony. Savers find investors and the money goes to productive projects, and it all sounded great. The problem is it's really hard for you, having saved $4 or $5, to find someone who wants to borrow $4 or $5 and pay interest on it. It's hard for savers and investors to find each other. There's information problems in the market. And so we will often have financial intermediaries. Institutions, banks are the most common ones, but not the only ones. I'm going to talk about banking today just to help bring the idea in that market, the loanable funds market, relies heavily on banks, which means that our growth relies heavily on banks. So let's talk about what banks are. Banks are financial institutions. We bring our money to the bank as savers. We have money that we're not currently using. This could be literally in a savings account or even just your checking account if you leave money in there for a while. That's savings. You didn't spend it immediately. You bring it there and you deposit it. At which point, it's an asset to you. Your account there is an asset. And it's a liability to the bank. Why is it a liability? Because at any given point, you can go back and say, give me my money back. So that's a risk for them. Once they have those deposits, they don't actually keep them all in the vault. They will actually end up lending most of that money away. We have a fractional reserve system, which means they don't have to keep all the money. They can keep 90% of it, or whatever rate the government you're in chooses. So they will stand at the middle. They will vet their depositors and they will vet their applicants for loans. They stand in the middle and help those dollars to get from the savers to investors. It's a really important thing. So let's give a little bit of an overview of what a bank is and how we regulate it and some of the important questions about regulating banks. So a bank, in short, takes deposits and makes loans. That's their primary job. There are lots and lots of private banks or commercial banks, and there's different flavors of them. There's commercial banks and savings and loans and credit unions, but they're all kind of the same thing. When I say bank, that's what I'm talking about. There's a central bank, which is a different animal. The central bank is established by the government and is in charge of the money supply and in charge of a lot of banking regulation. We will come back to them in a lot of detail later because they're going to be really cool when we talk about monetary policy. There's also a shadow banking system of institutions that aren't exactly banks, and so they're not regulated the same way, but they still have kind of a deposit and loan sort of setup. And so they will be subject to a lot of the similar risks as banks, even though they don't have as many of the regulations. All right. Now, what's a bank have? They take deposits. That's their main liability. They make loans, and the loans become an asset to the bank. So a quick, super brief foray into accounting. Banks have balance sheets. Their liabilities have to be equal to their assets plus their owner's equity, or the value of the company, the net worth of it. Now, what are their primary assets? The loans that they give to you, the money in their vault, also called reserves, and any securities they may own. Securities being financial instruments. Now, what are its primary liabilities on the other side? Your deposits, and then anything that the bank has borrowed from other banks or other institutions. So they've got these assets, they've got these liabilities, and with these come a substantial amount of risk. Okay? For instance, if they give you a loan and you don't pay them, then one of their assets just collapsed and stops giving them income. That's a problem for the bank and for you because they'll take your stuff back. So that's credit risk. Credit risk is the risk that their borrowers might not pay them back. There's other risks too. There's market risk, where conditions could change at a bigger level and affect the value of their assets or increase the burden of their liabilities. And there's liquidity risk, which is that if they don't have enough cash on hand, they might have to sell their assets at a loss to meet their short-term obligations. These risks are always present. But if they hold enough cash on hand, it's usually okay. The problem, though, is where do they earn most of their money? They earn a lot of it by giving loans. And so there's an incentive for them to loan out too much and to take on extra risk, because that's where the money is. So there's a balancing act that they need to play of making money versus protecting themselves against the rainy day. Now this brings us to our next point, because banking has changed over time. It used to be that they would originate to hold, meaning you'd make a loan, like give someone a mortgage, and then the bank would hang on to the mortgage and collect the money every month for the next 30 years. When it was like this, the bank was very interested in your being able to repay, right? I mean, that makes sense because your loan is their asset. And so their profit would come from the gap between the interest on your loan and the interest that they pay on your savings account. The gap between them is just interest coming to them that they don't have to pay to anybody. That's where their profit would come from. But in recent years, there's been changes, which is that now we don't originate to own. There's a much more common thing now called originate to distribute. We make a loan, like on a mortgage or something, or a car loan or whatever, and then we sell the mortgage. We sell the loan to a different group. And there are specialized financial intermediaries that bundle all these loans together and sell them on financial markets as investment, like financial investments. You can buy a share of this portfolio of mortgages and collect the income that comes month after month as people repay their mortgages. Which on one level is really cool because you get to diversify, you get to spread out your risk. Mortgages are typically safe, but on the other hand, it creates some bad incentives. A bank, for instance, might be less interested in whether or not you can pay back a loan because they don't actually collect your money. They make the loan and they sell it, and they don't really have to care what happens after that. Now, it's not quite that simple, and I don't want to sound cynical. I'm just saying that the incentives change a little bit. And this ends up playing a major role in why we had a big housing bubble and a financial meltdown in 2007 and 8, which triggered a global recession, and the biggest recession we had had since the Great Depression. It can be a big deal, just saying. Now, if their actions can trigger big recessions and big problems that affect lots of other people, that means that we should have questions about, should they be allowed to do this? Should we regulate it? How should we regulate it? Who should pay the bill when a bank goes bankrupt? Should we just let them die, or should we save them? Those are big questions, and people get really passionate, might be a nice word for it, but they fight a lot about it. So we do regulate banks because they're playing with other people's money, and the government tries to limit them so they don't take excessive risk. Some risk is necessary. We try to limit it to a manageable level. So we have certain standards like capital requirements where we don't let them get too over leveraged. The Federal Reserve Bank, our central bank, acts as a lender of last resort during times of crisis to lend money to struggling banks when no one else will. And another big one is deposit insurance. If you're in the United States, whenever you go to a bank, they always have stickers everywhere that say FDIC insured. It's the Federal Deposit Insurance Corporation. And lots of other countries have stuff just like it. But what it is it's a guarantee from the government that if this bank goes bankrupt, you get to keep your money. And there's a limit on it. It's like $250,000 per person per bank. But as long as you have less than $250,000 in the bank, your money's totally safe. And this really helps banks because it helps prevent bank runs. If I think my bank is going to go bankrupt and there's no deposit insurance, I run to the bank and I take my money out of it. But when I do that, I give them liquidity problems, and then they probably will go bankrupt. It's a really vicious cycle. So one of the policies we have to protect the system is deposit insurance. But if all else fails, the government might get involved in facilitating mergers or closures or whatever. And when a bank dies, they can get their assets and their accounts can get absorbed into a different bank and stuff like that. So there's a lot going on here. After the financial crisis, it got even more complicated because we passed bills like the Dodd-Frank Act to try to make banks, be careful, but also to address the shadow banking. I mentioned that at the beginning. They're not subject to all the same regulations as the banks, but they still play a major role in our financial system. So I know this was kind of a weird overview video. I just thought it was some interesting stuff. There's nothing like really technical that we've talked about. There's going to be a lot of vocab, and I didn't really define much of it, so you're going to have to use your book. I just wanted to put some of what we're going to learn in context, and I hope it's helpful. If not, you probably figured that out before you got to this point and turned off the video 12 minutes ago. So, whatever. And if you're still here, thanks for watching, guys. Good luck and happy econing.